Bond funds are quite interesting because we do get a lot of people in the group who might have cash sitting there, and hence they join a group to learn about stock picking because they want to get more out of their cash, and they might look to find equities that might pay dividends. But for those out there who want a cash-like bit better than cash-like return, or investing into more secure products such as bonds, what sort of options do they have out there?
Yeah, so we have a cash ETF first and foremost. So they just want to continue to remain invested in cash, which we think pays a pretty good rate given the current environment. But of course, that's still very, very low. So you're not going to get not going to get rich of it. But if you just want to be invested in cash and you don't have a good rate, like perhaps you're getting almost nothing from the bank, this at least gives you a little bit. But again, I'll just say, just given where the interest rates are and are likely to be after Melbourne Cup Day, those are going to be very, very low. So look, that's about 65.65% a year. So nothing to sort of get particularly excited about, but obviously makes sense within a portfolio. I think the way that we think about it is you've got to basically start going up the risk spectrum from there. And again, this is all less risky than shares. So the most risky non-share exposure that we have is hybrids, which some of your investors wouldn't know. It's got shares characteristics of shares and bonds. So the interest rates on those float with the interest rates in Australia, but that is a fund called HBRD, and it's managed by a fund manager who's very expert in this particular field, and it will have much more. We call it risk, or we call it volatility, which is another word for risk. It will have much more volatility than bonds, but quite a bit less than shares, maybe half that of shares. So that's probably paying you right now, before franking credits, 2.5% or so a year. So again, that's significantly more than the 65% I just mentioned. So that's one way to get exposure. But there will be we would expect some volatility in that. And then you just keep on going down the list. So then you go into things like credit exposure. So in other words, these are borrowings of bonds that have been created by companies, and they are corporates. That's what we call it, corporate or credit bonds. And that will give you, again, a lower exposure, a lower yield than what I just said, but perhaps a little bit of a lower risk as well, all the way through to ultra safe things like Australian government bonds, and which is AGVT. The fund I mentioned before is called CRED, by the way, CRED. Yep. The AGVT fund is Australian government bonds, and the global government bond fund we have is GGOV. So we've got a big range, and in fact, we've also got a range of a fund that's actually just all bonds in one place, which is called BNDS. In case somebody just wants a bit of a set and forget bond exposure, it's managed by a really high quality, world-class, bond manager, and it gives you exposure to the whole bond scene actively managed, which might be a way to just get exposure to a set and forget sort of bond product.
Yeah. What a lot of people out there don't realize is that this bond sector, it is so complex, and there's so many options. It's not like just putting money into term deposit. There's so many different risk characteristics that come into it, and therefore income characteristics that come about it as well.